Good evening from New York. It's 5:53 p.m. on Tuesday, March 31st, 2026. Welcome to the Lynx Data Insight market briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. The U.S. stock market is closed, and what a session it was. We just witnessed the strongest single-day rally in months. Walk us through the numbers.
This was a broad, aggressive risk-on session. The S&P 500 surged 2.92% to close at 6528.65. The Nasdaq led with a 3.84% gain to 21,592. The Dow added 2.48% to 46,339. Small caps joined the party. The Russell 2000 jumped 3.41% to 2496. Breadth was emphatic, 355 stocks advancing versus just 157 declining. The VIX dropped to 25.27, still elevated but well off the panic levels we've seen recently. The 10-year yield sits at 4.31%, the 2-year at 3.60%, giving us a normal yield curve with a 71 basis point spread. The regime here is clear. This is a geopolitical sentiment-driven relief rally within what remains a supply-constrained, oil-shocked macro environment. Three drivers today. First, President Trump signaled productive talks with Iran, which sparked the risk-on move. Second, OpenAI closed a record $122 billion funding round, reinforcing the AI capital deployment narrative. Third, and this is the structural story underneath it all, Microsoft just finished its worst quarter since the 2008 financial crisis, down 23% for Q1, which is emblematic of a broader repricing of traditional software names into what some are calling the SaaS-pocalypse.
So the market rallied nearly 3% on the Iran headlines, but crude oil is still above $102 a barrel. How much of this rally is sustainable versus a short squeeze on hope?
That's the right question, because the underlying supply shock hasn't resolved. According to CNBC, regular unleaded gasoline has eclipsed $4 nationally at the pump, and U.S. crude oil is priced above $102 a barrel. Brent crude futures actually fell 3.8% on the day to $103.28, which tells you the market initially traded down oil on the diplomacy headlines. But the key word from Trump was productive talks, not ceasefire, not agreement. So we got a repricing of the tail risk of escalation without any actual resolution to the supply disruption. The rally was broad enough to be real. Airlines like United, up over 6%, are telling you the market is pricing a potential cap on fuel costs, but the VIX, still sitting above 25, tells you nobody is putting away their hedges. This is a market that wants to believe diplomacy works, but hasn't verified it yet.
And that oil dynamic feeds directly into what the Fed does next. What did Powell's comments actually change?
Powell's remarks Monday were the single most important input for rates this week. He explicitly said the tendency is to look through supply shocks, because by the time rate hikes take effect, the oil shock would likely be gone, and you'd just be weighing on an already weakened economy. The 2-year yield at 3.60% is your market proxy for the terminal policy rate, and it's telling you the market sees no hikes coming. CME FedWatch futures as of Tuesday morning showed just 2.1% probability of a hike by year-end. Meanwhile, the probability of cuts has climbed to roughly 25%. Carlyle's Jason Thomas made the most important observation of the day, according to CNBC. If the labor market deteriorates under demand destruction from sustained $100-plus oil, rate cuts could arrive as soon as September and in increments greater than 25 basis points. The causal chain here runs 4 steps deep. Elevated oil above $102 flows into consumer gasoline costs above $4, which compresses discretionary spending, which slows hiring, which forces the Fed's hand toward emergency easing. The OECD just raised its U.S. inflation forecast to 4.2% for 2026, but that's headline inflation, driven by energy. The Fed targets core, and Powell's framework says you don't hike into a supply shock that's already doing the demand destruction for you. RSM's chief economist Joseph Brazulis called this the classic stagflation dilemma. No clean answer, but the Fed will likely remain patient and then cut aggressively if it falls behind.
Wait, the 10-year at 431 and the 2-year at 360 gives us a 71 basis point normal curve, which should signal a healthy economy. But the underlying breadth data tells a completely different story. That's a contradiction worth exploring.
It is, and this is where the sector breadth data becomes essential. The yield curve is saying no imminent recession, but when you look under the hood, whole sectors are in acute distress. Financial services, which is $7.57 trillion in market cap, has just 5.71% of its stocks above the 50-day moving average. That's the worst reading of any major sector. Real estate at $1.11 trillion, nearly 42% of its stocks trading near 52-week lows, with only 19% above the 50-day. That's the 10-year at 431 crushing rate-sensitive valuations. Consumer cyclical, $6.29 trillion, has only 7.55% above the 50-day, the second weakest among major sectors, with nearly 19% near lows. Industrials at $4.77 trillion show just 13.7% above the 50-day. These are massive sectors being quietly gutted, while today's headline rally focuses on semiconductors and the Magnificent Seven. The market isn't healthy underneath the surface. It's bifurcated between a handful of war beneficiaries and AI plays on the one side, and an increasingly damaged consumer and rate-sensitive economy on the other.
So, who are the clear winners and losers from today?
On the cyclical winner side, semiconductors dominated the top gainers. Monolithic power systems surged 8.33%, ON Semiconductor jumped 8.04%, SanDisk gained 7.75%, and Teradyne was up 6.50%. 6 of the top 10 gainers were technology names, almost all semiconductor or AI adjacent. The catalyst was both the broader risk-on tone and the specific news that NVDA is investing $2 billion in Marvell technology, which popped 13%. Jensen Huang called it an expansion of our ecosystem. Supermicrocomputer rose 6.4% on the AI server infrastructure rebound. Outside of chips, Comfort Systems gained 6.11% as a direct beneficiary of data center construction, and United Airlines rallied 6.07% on the Iran talk hopes capping fuel costs. Coinbase added 6.8%, a pure crypto-adjacent risk-on play tracking the Nasdaq surge. The structural winner is unambiguous: energy. 100% of energy stocks are above both the 50-day and 200-day moving averages. 82% are near their 52-week highs, 0% near lows. That's maximum bullish breadth across a $2.32 trillion sector, a war-driven structural uptrend with no dissenters. Utilities are the defensive winner, 77% above the 50-day, 71% near highs, 0% near lows. That's a broad-based defensive bid as recession fears mount. On the loser side, the paradox of the day is that energy exploration and production names actually sold off despite $100 oil. 5 of the top 10 losers were energy stocks. EOG Resources fell 2.99%, Coterra dropped 2.87%, Devon Energy lost 2.71%, APA fell 2.53%, and OneOak declined 3.43%. This is classic profit-taking after an extended run. These names have been relentlessly bid for weeks, and the productive Iran talk headlines gave traders an excuse to book gains. CF Industries, a basic materials fertilizer name, was the day's biggest loser, down 4.43%, which is likely profit-taking in the same commodity-linked rotation. Hershey dropped 3.33% on input cost inflation, cocoa and sugar prices compounding with the broader energy-driven margin squeeze.
The Magnificent Seven all participated in this rally, but the dispersion within that group is striking. Break down what's happening there.
The dispersion is the story. NVIDIA led with a 4.44% intraday gain, closing at 174.38. It's down 7.65% year-to-date and trading below both its 50-day at 182.81 and its 200-day at 179.47. But the Marvell investment and continued AI infrastructure demand are keeping it as the highest conviction megacap. Meta Platforms surged 4.05% to 572, but that comes after a brutal 12.59% decline over the last month and nearly 22% over 6 months. It's trading well below its 50-day of 640 and its 200-day of 685. Alphabet gained 3.43% to 287.57, but is down 8.69% year-to-date and sits below its 50-day of 311, though still above its 200-day of 263. The real outlier is Microsoft. Despite the headline that it gained 1.52% today, closing at 370.16, this stock is in deep structural trouble, down 21.55% year-to-date, trading at 370 versus a 50-day of 406 and a 200-day of 476. According to CNBC, the stock just closed its worst quarter since 2008. Only 3% of commercial office customers have adopted Copilot. The company is reshuffling its AI leadership, and the sauce apocalypse narrative, names like Adobe, Atlassian, ServiceNow, all down over 30% this year, is pulling the entire traditional software complex lower. Amazon gained 1.66% to 208.29, but is down 8% year-to-date and below both moving averages. Apple rose 2.38% to 253.79, down 6.27% year-to-date, and is battling a new narrative risk from its crackdown on AI vibe coding apps, which, as CNBC reports, puts it on the wrong side of the developer ecosystem shift. Tesla added 2.8% to 371.75, but is down 15% year-to-date and below both moving averages.
OpenAI closing at an $852 billion valuation, and Oracle cutting thousands of jobs. These feel like two sides of the same AI repricing coin. How do they connect?
They connect perfectly to the macro narrative because they illustrate the AI capital cycle's winners and losers simultaneously. OpenAI closed $122 billion in committed capital, according to CNBC, with Amazon at $50 billion, NVDA at $30 billion, SoftBank at $30 billion, and it's now generating $2 billion in revenue per month, but is still unprofitable. That money is flowing into the infrastructure layer: chips, servers, data centers, networking. That's why NVIDIA, Marvell, Monolithic Power, Supermicro, and Comfort Systems were today's cyclical winners. Oracle, on the other hand, represents the companies that are trying to participate in the AI infrastructure build-out but can't fund it organically. Oracle has raised $50 billion in debt and equity. Its stock is down 25% this year, and now it's cutting thousands of employees, a move TD Cowen estimated could generate $8 to $10 billion in incremental free cash flow. The technology sector's breadth tells the full story. Only 21% of tech stocks are above the 50-day moving average, and just 1.23% are near their highs, despite being an $18.89 trillion sector. AI is creating enormous winners and simultaneously destroying the traditional software business model, and the market is repricing both at the same time.
Let's stress test this rally. What's the risk case investors should be positioning around?
Our base case, which we'd assign about 55% probability, is that the S&P trades in a range of 6350 to 6650 over the next week, the 10-year oscillates between 420 and 445, and oil stays in a roughly $95 to $108 band. The Fed holds through at least September. In this scenario, Iran talks provide intermittent relief rallies, but elevated oil, the VIX above 25, and the AI repricing keep the market range-bound with a defensive bid in energy and utilities. The risk case, roughly 30% probability, is that Iran talks collapse or military escalation intensifies, pushing WTI sustainably above $115. The causal chain, oil above 115 forces immediate consumer retrenchment. Mercedes' U.S. CEO told CNBC today that if gas stays near $5 for 90 to 120 days, it becomes a bigger distraction from car purchases, and that logic scales across all discretionary spending. Nike just reported gross margins down 130 basis points on tariffs alone before the oil shock fully hits consumer wallets. Demand destruction tips the economy towards a recession. Earnings estimates get cut across consumer cyclical and industrials. The 10-year drops to 390 on flight to safety, and the S&P could revisit 5,900. In that scenario, the Fed is forced into emergency cuts, potentially in increments larger than 25 basis points, as Carlyle's Thomas suggested. The upside tail, about 15% probability, requires an actual Iran ceasefire or de-escalation agreement that collapses oil back below $80. That removes the stagflation overhang. The 2-year reprices towards 325 on renewed cut expectations, and growth stocks re-rate sharply. The S&P could reach 6,900 as the sauce apocalypse narrative reverses and pent-up consumer confidence releases.
So, what does positioning look like right now?
Highest conviction, energy producers. Maintain or increase exposure immediately. 100% of the sector above both moving averages is as clean a structural signal as you'll find. And even if talks progress, the supply deficit doesn't resolve overnight. Secondary conviction, semiconductor and AI infrastructure names, NVDA, Marvell, Monolithic Power, Supermicro, and Comfort Systems. But size positions for elevated volatility. The 5-day annualized volatility on NVIDIA is over 67%. Tactical, if the VIX pulls back towards 22 or 23 on further diplomacy optimism, that's your window to add put spread protection on the Nasdaq. The utilities sector as a hedge, with 0% near lows and 77% above the 50-day, is the cleanest defensive allocation. Avoid rate-sensitive consumer cyclical and traditional software. Consumer cyclical has only 7.5% above the 50-day, and the compounding pressure of tariffs, oil, and a cautious consumer makes these dead money at best. Financial services, with under 6% above the 50-day at $7.5 trillion in market cap, is a sector I'd underweight until we see clarity on credit quality and loan growth in a potential slowdown.
How does it all fit together?
When you step back, this is really about a market caught between two gravitational forces, a geopolitical supply shock that's repricing inflation expectations and consumer economics on one side, and an AI capital cycle that's simultaneously creating the next decade's infrastructure winners while destroying the current decade's software incumbents. Today's rally was a pressure release on the geopolitical side, not a resolution. The cross-asset picture confirms it. Equities surged, but the 10-year barely budged at 431. Oil pulled back on talk of talks, but remains above $100. And the sector breadth shows a deeply bifurcated market, where energy is at 100% strength, while financial services, consumer cyclical, and real estate are in structural deterioration. The alternative view, and it's a serious one, is that this market is actually more resilient than the breadth suggests. Today's 355 to 157 advanced decline ratio was the best in weeks. Microsoft's David Davidson analyst Gil Luria argues the stock sell-off isn't justified given 17% revenue growth, and if Copilot adoption inflects even modestly from that 3% base, it could reverse the sauce apocalypse narrative quickly. Powell's dovish framing also means the Fed put is alive. They're not going to hike into this, and if growth falters, they'll cut. That's a floor under equities that bears consistently underestimate.
Let's get the 3 takeaways.
First, the risk. The VIX at 25.27 with oil above $102 means this market is one failed headline away from giving back the entire today's rally. Do not chase this move without protection in place. Second, the insight. Sector breadth extremes are the real story beneath today's tape. Energy at 100% above the 50-day versus financial services at under 6% versus real estate with 42% near 52-week lows. These divergences don't persist without something breaking, and the resolution will define the next quarter. Third, positioning. The highest probability trade over the next 30 days is a barbell, Energy producers and utilities on the long side, funded by reduced exposure to traditional sauce and rate-sensitive consumer discretionary. Time horizon is through Q2 earnings, with the September Fed meeting as the key catalyst for any rebalancing.
Thank you for listening. This is Lynx Data Insight, and we will be back tomorrow with your next market briefing.